Understanding how cash flow works with a real estate investment. All right, guys, we're going to talk all about how cash flow works on real estate investments and what you need to know about them. And I think this is a little bit misunderstood. It's pretty simple in practice, but it has some complexity when you really dig into it, which is what we're going to do today. But before we do, we've got to give a shout out. Thank you for asking this question. If you've got a question you'd like to have me answer, type it in the comments below and I'll put put a video together just like this for you. Okay, so here's the thing. In our house, we say cash flow is king, equity is queen, and debt is a joker. That's kind of our thing that we like to talk about. So it's all about establishing cash flow. So to do this, what is cash flow? We're going to start over here. Cash flow is the difference between what you get in rent minus your expenses equals your cash flow. Okay, so that's a pretty easy formula when you really think about it. But the real question is what's included in these expenses? And that's something people don't really think about. So let's talk about it. First thing you've got to look at is management. Are you managing the property or are you paying for management? If you are, managers are typically 8 to 10% to manage the property, so you've got to plan on that. Next thing you've got is your mortgage, okay? Your mortgage payment, however much your mortgage payment is, you've got to put that in there. Let's just use a really easy example. Let's just say this property rents for $1,000 and let's say your management's $100 and let's say your mortgage is I don't know, 700. Let's make this kind of easy for our numbers. Then you've got taxes. Lots of times the taxes will be included in your payment. We'll pretend like that's the case here, that it's already included above when we talk about taxes. Now you may have an HOA. If this is in a condo or something like that, you may have an HOA. I'm going to say there's no HOA on this specific property because I'm a little bit partial to single family houses over condos for the most place. But you've got your HOA. Now we start getting into some of the nitty gritty that most people don't think about. So now you've got your repairs. Okay, and what I plan on is 5%. So I'm going to put $50 in repairs a month. Then I've got my capital improvements, and I put $50 a month into capital improvements. What are capital improvements and the difference between repairs? This is like a new roof, and this is like fixing a toilet. So these are little things you're going to do along the way, and this is a big thing that you're going to do every 10 years. That's what I like to call capital improvements. And then the other thing you're going to have is vacancy. Okay, and I put $50 a month towards vacancy, but my vacancies, I have a vacancy like once every 5 years. My typical tenant stays for 5 years. Now that's by design, not by default. I put a unique strategy together. If you'd like to hear more about that, type it in the comments. I'll put something together. So basically when you take all of that, then what are we at here? 950 is basically what we're looking at here. So that equals 950. So that would give me $50 a month. That would be my true cash flow. Now, a lot of people are not going to take their repairs and their vacancy and those things. They're going to say that they're cash flowing at $200. And I'm okay with that. But just keep in mind, you are going to have these vacancies, repairs, and capital improvements. And so that's what you're going to be looking at as a true cash flow when it comes to it. Now, these things are going to be offset. Some of these, like these capital improvements, are going to be offset with taxes because I'm going to be able to write off the expenses that I'm having in these, which is going to help lower my taxes to help offset some of that. So that could be really helpful. The other thing I'm going to have is a depreciation schedule, and I can do that on a straight line depreciation, or I can do an accelerated depreciation on these types of things at the present moment. There is some talk that might be changing. Now, if you're liking this video, and I certainly hope that you are, hit that thumbs up button. I really would appreciate it, and it means a lot to me. So this is the whole idea of cash flow. The cash flow is the difference between the rent and the expenses equals your cash flow. You've got to itemize and know exactly what those expenses are. Now, so the question really is, how do you make money in real estate investing? If you're only making $50 a month, how do you actually make any money on this? Well, one way that you make money is appreciation. Okay, every single month or over time, real estate goes up. Now it goes up and down, but over time, real estate goes up. It appreciates over time. Number two, you have what's called amortization. the idea is every single month when your tenant pays this payment, a certain portion of that is actually paying down your loan. So let's say it's $100. You owe $100 less than you did before. That doesn't count into your cash flow because it's an expense to you, but it's helping to grow your equity in the property. And we call that amortization. The other one that we have is taxes, like we talked about, with straight line depreciation, accelerated depreciation, and some write-offs along the way, which helps lower my tax expense, which helps me have more money in my pocket and along the way, which is really nice. And the next thing we're going to be talking about is raising rents, because that's the other thing, is you're going to see rents go up over time as well. Now, yes, they're up and down, and there's markets, but if you take 20 years ago till now, rents are higher, and that includes, even if you go back even further, 30 years from now, which includes like your 2008, you're still seeing rents higher now than they were 30 years ago. And so that's what we're talking about when it comes to cash flow on real estate investing. And here's what I've got to tell you. This is a long-term play, especially if you're leveraging and having to get a mortgage, which most of us have to when we're getting started in the real estate investing. We've got to get a mortgage. The terms of that mortgage is really important, and refinancing that to get the lowest interest rate is really important. But this is a long-term play. Not only is it a long-term play, but it's a play you're going to want to be doing over time. One of the things you can do is what's called dollar cost average. You could buy a house every single year, and that way, if the market's up, the market's down, the market's up, the market's down, you're buying the dips, you're buying the lows, you average that out, and you end up with a good baseline for your investments. But this is all about cash flow, what you need to know about cash flow, and what it is to make things happen. Now, this money that you have can then be invested to either pay down your debt, or you can take that money to actually start purchasing or acquiring some money to buy another investment property. So, I hope you've enjoyed this. If you'd like to get a copy of my property value analysis, this is what you can use to help determine if the property you're looking to buy is worth it or not. Send me an email, or excuse me, send me a text, your email address. So text me your email address, 435-294-0433. Text me your email address and I'll send that out over to you absolutely free. I've also got a great video, investing for cash flow versus investing for profit. You want to check that one out, as well as a blog post, do I need cash reserves to apply for a loan? Check that blog post. I'll link it in the description below. If you're not a subscriber, I would sure love to have you. I do a video of the day just like this and would love to have you as a subscriber. Hit that subscribe button. Otherwise, make it a very profitable day, and bye for now.